mean reversion, how does it work? How do you apply it to markets? And honestly, the biggest question that I get, because so many of our viewers have become more aware of how mean reversion works, both with trading options and volatility. And, when volatility spikes, selling options; when volatility is low, trying to get some long option strategies in there. That I want to spend a little time on the concept, but I also want to talk about just the different time frames, because mean reversion is something that if you're looking at multiple years, or you're looking at just the last few months, or you're looking at the last 24 hours, you can have a bias that is long, short, and long, or short, long, long. Like it could be telling you many different things. And so a lot of people tend to be like, well, how do I use this thing in terms of timeframes? And so we'll get into all of it. But at the end of the day, mean reversion for you and me, futures and options trading, it runs almost all of our strategies, right?
Exactly. It's a great way to identify opportunities. It also helps us, keep our emotions in check at certain times. So it definitely touches a lot of different aspects of trading that are not only from like a mechanical entry exit perspective, but also some of that like grayer stuff when it comes to management, rolling out in time, or figuring out like what your next move is going to be.
100%. And I'm glad that you bring up that emotions thing. Or for me, it's always, this might sound bad, but like Frank tries to have as few opinions of what's going to happen as possible. And what I mean by that is like the idea of, oh, well, did you read, what happened last week? Because, so-and-so said this. And so interest rates are definitely going to go higher. Or like, oh, did you see like, this number came in and this number tells me that the end of the world is coming. And because of that, interest rates are going down to negative. I think they're going negative. I like to depend on data, especially, equities are different. They don't show a lot of mean reverting qualities, but when you have a plethora of asset classes, interest rates, a lot of commodities like crude oil, natural gas, gold, silver, markets that have been around for decades, if not centuries, Katie, have a lot of historical data. And in all of those years of hundreds of data points amounting to thousands there, Katie, a lot of them, especially look at the 10-year, tend to live in a certain environment here and kind of oscillate around an average price. And that's what mean reversion is at the end of the day, right?
Exactly. Perfect.
And so what you have here is the 10-year yield, and you can see when times were hunky-dory prior to the pandemic, 10-year yields are up near 3% and climbing. Pandemic and some of the fears come in, and 2019 there's some fears, but then obviously 2020 we see all of the COVID stuff breaking. Rates take a break down to their average price, and then far below it they get near zero, and that's when you have a lot of the people coming out of the woodwork to say that interest rates are going negative and all these different things. And that's, like I say, when Frank likes to say like, the opinion not so interesting, but I can buy this thing because it's near zero and it's never gone through zero before. That's the basic premise of this strategy. It sounds like a big, scary strategy, right, Katie? But at the end of the day, it's just the average of like a data set, right? I've got the Excel sheet right in front of you here.
Yeah, exactly. And I think that, this goes back to when did we in grade school start learning about like mean, median, and mode? But for me, it becomes much more powerful, and was really powerful for me as a new trader, right? Who was like, well, I don't know what the price of SPY is supposed to be, or I've never traded gold before, so I don't know whether I should be long or short, because I just have no idea around like what is normal for a price of gold or any other product that is out there. So this is when mean becomes more important, because it also helps you gain context to then allow you to figure out if you want to be long, short, neutral, and if you want to flip-flop that idea, in a day or in a week or so on and so forth.
I like that idea a lot, which is like, I'm new to this asset class, or I'm new to trading in general. How do I get a lay of the land? It's like the first time you spend a grocery shopping session at a new grocery store. It's like, all right, I gotta walk around, see where everything's at. And then hopefully a couple of weeks or months from now, I'm able to tear through this thing like it's nobody's business and get everything I need to get done. I'm working the sales and everything else. The average price, and then just and you can do this intuitively. You don't need to calculate this stuff. If you open up your charting package on whatever platform and you look at the last year or the last couple of years, if they've got data for it, and just be like, oh, okay, this thing has tended to trade. And we'll use this example. We'll continue with this example. It's gotten as low as $5, as high as $30. And it looks like it tends to hover around $20, which is to say 2% in the 10-year yield. Now, with all of that in mind, you've kind of just intuitively created a mean and standard deviations for where you might be buying or selling this market. But Katie, you can apply it to different time frames. And so while this chart, looking at the last couple of years here, might say, oh, it's very efficiently priced right there at that mean. This chart for just the last few months tells you, man, this might be a selling opportunity here with the market well above its last year's worth of prices. And that stuff can at first blush make you think like, oh, should I be, flat, short, or long this thing, right? It's a little confusing at times.
Yeah, I think too, traders fall into the trap of almost like over analyzing to the point where they're almost like trying to cherry pick and find a chart that almost fits their idea and be like, well, in this instance, like, yeah, of course I would be long or short because this chart's telling me this. So there's that trap, but you also have to take into consideration what we've just experienced the last 2 years. So yes, is it really fair to look back all the way to 2017 or 2018? Or depending on how long we want to be in this position, should we be looking at the shorter time frame like you have up here?
You absolutely just nailed it. And yeah, you're totally right on that first note of like people will research stuff in trading or anywhere to talk themselves into or out of decisions, especially in trading. If you're new and it's like, oh, like, okay, I've got an idea based on what I normally look at, but let me do some digging. And then it's like you try to find a statistic that talks you out of that thing, and then you never trade here. The last point that you made is essential, which is let the time frame with which you want to be in the trade dictate how much in the past you're looking. Like if you're looking to buy or sell yields, Katie, and you're like, I want to make a long-term investment in long or short yields for the next several years, then this is relevant. And this would tell you there's not really an edge one way or the other. If you're looking for, multi-week opportunities, like a lot of people I know on the Tasty Trade Network look at, 45-day opportunities, this market relative to its mean for the last couple of months might be showing you that opportunity to sell, given that its mean for the last year is around $15. The market is up to close to $20. And then also last piece, this is how we day trade a lot of times, right? We just say, hey, the mean is 0. And when the market gets, far away from that 0 net change mean, we're selling it if it's up 50 cents based on these standard deviation calculations, or buying it and it's funny, just yesterday sold S10Y because it got up to that it got way past that last couple months worth of mean. And then today I got out of that position, and then the market is down 50, 60 cents. I'm looking to buy it on a day trade instead. And that's how you choose the mean that works for you, right?
Yeah, I was just going to say, like, it's literally S10Y is down literally 52 cents right now. So I was like, oh, this might be a good time for me to actually buy into a position with hopes of a quick little pop here. But again, yes, it's all about time frame and how long you're expecting to try to stay in this trade.
Exactly right. Well, Katie, thanks so much for joining us here on Small Stakes. Always, always, always a fun time to have you on. We're very thankful for that. And we're very thankful for our viewers out there. If you need anything, you can always reach out to Katie or I on Twitter, also on email. We're relatively easy to find. Frank at Tasty Trade, Katie at Tasty Trade, I believe. And with that, we will leave things to Peter Bomat and Splash into Futures coming up next. You're definitely not want to miss it. There's plenty of trades to be done from my good friend Pete. Thanks, Katie, and thanks everybody for watching. Peace.